Good afternoon. Welcome to Lockheed Martin Retirement Maximization, how to not miss out on what you're entitled to and get every last penny you can get before your retirement countdown clock. And you know you have one, show zero. Welcome, folks. My name is Josh Strittmatter, and I am the founder and CEO of Strittmatter Wealth Management Group. We're a financial planning firm here in Fort Worth, Texas. I've been a financial planner since 2003, a Lockheed Martin retirement specialist, and then I've been working with Lockheed employees for 18 years now. I'm also a certified financial planner and a certified retirement counselor. I have a great team that backs me. We have other advisors in the office who also work with Lockheed employees. We do comprehensive planning. We have combined 35 years experience, and we are certified financial planners. Some key disclosures before we get going today. All of the information today is meant to be educational. Please talk to a licensed professional before taking any action today. And then let's get into our course outline. Today we'll talk about the changes to your Lockheed benefit plans, your Lockheed Martin Pension, and we'll go over the ins and outs of that and a key strategy that you can use to get more out of your pension. We'll talk about your Lockheed Martin 401k plan and some key strategies around that. We'll also look at your retirement healthcare benefits and what you're eligible for. We'll look at your portable insurances you can take with you, and then I'll show you the top 10 retirement mistakes to avoid when you retire from Lockheed. And then lastly, we'll look at how SWMG, Strittmatter Wealth Management Group, can help you retire if you'd like our help. So jumping right in, looking at what has changed with your Lockheed retirement pension plan. Here are all those changes. Back in 2006, the pension officially closed to new employees. So if you were lucky enough to be there before that time, you were able to participate in the pension. And then at the end of 2015, they froze the pay component of your pension plan. And we'll talk about how that's calculated, but that was one of the components. At the end of 2019, they froze the service component of it. And then in January of 2020, they started making or providing a 6% contribution to your savings plan in lieu of the pension contribution. So those are the recent changes. Let's now get into what a pension is. And so a pension is also called a defined benefit plan. It provides a specified monthly benefit to you once you're retired. And yours is based on a formula that looks at several factors, and we're going to go over those factors when we get to the calculation. Lockheed Martin employees are eligible for pension benefits when they have reached 5 years of vesting service or when they turn 65 years of age, the earlier of the two. So what is the difference between a defined contribution plan and a defined benefit plan? First of all, what's a defined contribution plan? That is your 401k plan. So what's the difference between your 401k plan and your pension plan? Here are the key differences. The first is with the defined contribution plan, the benefits are based solely on the amount that you save, the amount that's matched, and then the growth of that investment over time. You get an individual account that you can invest into, so you get your statement as you receive those. The employer can contribute on your behalf, but you can also save to it. So you can save your annual contribution to it. Contributions are based upon a percentage of your salary or pay. And so you elect how much you can contribute up to the limit. We'll talk about limits a little bit later. Participants are responsible for the investment selection. So you have to choose your investments, and therefore you get the results of what you've chosen. And the benefits grow tax deferred until you pull it out. And then you have to start taking money out of your 401k plan at age 72. Benefits for a defined benefit plan are a little bit different. So the benefit for a pension plan is based upon a formula, and that formula will pay you a monthly amount once you retire. As Lockheed employees, you are not required to make contributions to that plan, and so Lockheed made that benefit on your behalf. You're also not responsible for the investment selection, so Lockheed makes those investments for you, and they take care of the performance. The pension is gross tax deferred, and therefore what that means is that when you start taking it, it'll be taxable income to you. And you have to start your pension by age 72 as defined by IRS code. So those are some of the key differences. Let's talk about some of the advantages and disadvantages of a defined benefit plan, your pension plan. By the way, I did mention this earlier. If any of you have any questions as we go along here, you can type that into the chat feature. I'm happy to answer those questions as we go along. So looking at the advantages of your pension plan, the employer is responsible for providing the retirement benefits. So doesn't require you to save any money. They do it on your behalf. You know in advance what your benefit will be, so you can look that up. You can use that in your planning scenarios. Doesn't depend upon your ability to save. So again, you're not having to save any money. No investment risk for participants. They take on all the risk. Plan assets are managed by professional money managers so that you don't have to worry about that. Offers tax-deferred retirement savings. So money grows tax-deferred in the account. And again, you pay tax when you pull it out. It offers a cost of, well, actually, some plans offer cost of living adjustments. Yours does not. Yours pays a flat amount for the rest of your life. And then yours is not guaranteed by the Pension Benefit Guarantee Corporation either. The disadvantages is there are no individual accounts. So unlike your 401k plan where you get your statement, yours is a calculation. It may provide only a portion of the funds needed for retirement. The plan is often difficult to understand. And so as you've probably noticed, it's a complex calculation, not as easy as looking at a 401k statement. It doesn't benefit employees who leave before retirement. And that's because the benefit is far less than what's projected when you leave early. And the benefits are typically not payable until normal retirement age. Normal retirement age for Lockheed, again, is at age 65. And then most plans do not permit lump sum payments at retirement. And so those are some of the disadvantages of your pension plan. Let's talk about how your pension benefits are calculated. So Lockheed has a formula that's used, and it's based on 4 components: your final average pay, your Social Security breakpoint, the plan's accrual rate, and your credited years of service. We're going to look at an example of all of these, and here's your first example of the final average pay. Final average pay is the average of the highest 3 years of pay during the last calendar year's worked. The 3 pay amounts used do not have to come from consecutive years. So in this example, the pay, which again was frozen in 2015 for this person, showed you their compensation through 2015, and then the 3 top years were 2011, 14, and 15. And so total was 203,000, or 67,666 is the average. So that's the amount that will be used in the calculation. Next is the Social Security breakpoint. This is the average of the Social Security maximum wage base that's published annually, and it's based on your year of birth, and it's calculated as an average over a 35-year period ending with the last day of the year in which you reach normal retirement age for Social Security. So this is something you can look up, but Lockheed also has this table as well that you can look up to know what figure you'll use in your calculation. Third is the accrual rate. So accrual rate is what's used to multiply by the final average pay to determine your benefit. And you have 2 accrual rates based on 3 different formulas. So the first is for credited service up to 35 years. Your final average pay up to the Social Security breakpoint is multiplied by 1.25%. Then, and so you'll add all of these together. The second accrual rate is 1.5% times your final average pay in excess of the Social Security breakpoint times credited years of service up to 35 years. And then plus 1.5% of final average pay times credited service over 35 years. So again, 3 different calculations done, all added together. And then here is an example of all of those different components together. This is an example of a person whose final average pay was $95,000. The Social Security breakpoint for that person born in 1955 was $89,364. So in this example, we only have 2 calculations because he doesn't have the third component. So the first calculation is the accrual below the Social Security breakpoint, which is 89,364 times 1.25, and that's 1,117. Then you have the accrual above the Social Security breakpoint, which is the difference between his salary and the Social Security breakpoint multiplied by 1.5%, and that's 85. This person had 20 years of service, and that's why we don't have a third component of that calculation. And so you then would take the two added together, 111 or 1,117 plus 85, and you'd multiply that by the years of service, and that's 24,040. That's the annual retirement benefit. And then, and by the way, it's the normal retirement benefit, and I'll talk more about that in just a second. Divide that by 12, and you have the monthly benefit of 2003. So the normal retirement benefit is what all of the calculations for the different payouts are based on. In this example, it's that $2,003 amount. Now, when I say normal retirement age, so you can actually take your pension before age 65. What they do, well, they'll do a slight calculation difference, and you may get less money in doing so. So you don't have to be 65 to take your pension, just so you know. Let's look at some common distribution options for your pension. So the two most common are single life only and joint and survivor. You also have some variations of the joint and survivor, which I'm going to talk about, but let me first define what single life only is for you. Single life only is where the company pays you out for the rest of your life. And it's again, a same dollar amount for the rest of your life. It doesn't inflate. And then upon your death, there's nothing left to a beneficiary. So this is the highest pension benefit that you can receive because it's based on one life. Compare that to the joint and survivor. Joint and survivor pays out to you for the rest of your life, and then it will pay out to the survivor for the rest of their life based upon a percentage of your pension amount. So in the example of joint and survivor 100%, you're going to receive a dollar amount, and then your survivor, your beneficiary, will receive the exact same amount, 100% of what you were receiving. Compare that to the joint and survivor 50%, where they actually get half of what you were receiving upon your death. So this one pays you the least because it's paying the same amount over two lives. This gives you a little bit more, and this pays you the most. Now, one of the issues with a survivor payout that a lot of companies experience is that when you have a joint survivor and the beneficiary actually dies before the owner, the annuitant. And so what happens is if you chose a joint and 100% survivor, you'd be receiving less money than the single life only payout. And let's say that your beneficiary died in year 2, your spouse died in year 2. Well, with some companies, you'd be locked into a lower amount for the rest of your life. You'd be locked into that joint and 100% survivor benefit for the rest of your life. Well, what Lockheed has is called a pop-up provision. A pop-up provision pops up the pension amount back to the single life payout so that you're not stuck at that lower payout for the rest of your life. Now, there is something you should know. It's only in the first 5 years after you've retired does that provision take hold. So if your beneficiary dies after that 5-year time frame, you are indeed stuck at that lower payout. And that's something that we're going to talk about today for how to fix. So before electing your benefits, make sure that you evaluate all your choices carefully. And know this, that when you choose the joint and survivor payout, you are effectively buying a life insurance policy on your life. And in doing so, that life insurance will pay out upon your death to the beneficiary for the rest of his or her life. Another strategy that you can consider is actually taking the single life payout and buying a life insurance policy on your own. So rather than a company buying it on you, you can buy your own life insurance policy. And that policy may provide better rates and benefits, and therefore provide more income to you in retirement. So let me explain that idea to you. I'm going to use a hypothetical example of Bob here. Bob has 2 pension payout amounts. One is a single life payout of $2,875, And then the joint survivor is $2,010. Again, that's smaller because it's paying out over 2 lives. The difference per month between those two is $865. So Bob's getting $865 less when he chooses that joint and survivor payout. That's a lot of money, right? So Bob and Julia, his wife, can either choose the single life option and receive $28.75 during Bob's lifetime, and then again, nothing after his death, or they can select the 100% joint survivor option, which pays out $2,010 per month until both of them pass away. So it pays out over both of their lives. But if they choose the single life payout option and use the extra monthly income to purchase a life insurance policy on Bob, then that may help them to come out ahead. And what I mean by that is that the insurance policy may cost less than $865 per month. And so as long as that policy costs less and provides the same amount of benefit, you can come out ahead. And so in this case, that life insurance death benefit amount that they need to purchase needs to pay out $2,010 per month for Julia's lifetime. So they've got to buy enough life insurance that would pay out that amount. And again, as long as that policy is $865 or less, they will come out ahead. And here's why. Oops. So if Julia dies first, Bob can either cancel the insurance and now receive the $28.75 versus the $2,010. And the reason for that, again, is he only chose the single life payout, right? He was already getting the $28.75, but now he no longer needs the life insurance. So he can just simply cancel the life insurance or leave it to his heirs, leave it to his kids if he wants to. So that's a strategy that we use quite often, folks. And here are some important considerations that you need to know before doing this for yourself. The first is that you need to consider whether or not you can qualify for life insurance, because you have to go through underwriting and have health that can actually support buying life insurance. And so if you have some health issues that may preclude you from getting life insurance, this strategy may not be right for you. You also need to factor in the cost of the life insurance, obviously, and make sure that if it's going to work for you, that you get the policy enforced before you choose your pension payout option. So don't do it the reverse. Get the life insurance enforced, write that first check to the life insurance company, and then you would choose your pension payout amount. So then the question is, well, how much life insurance do you need? Well, that's done on that's basically a calculation, and it is a present value of a future payout, future cash flow. And so here is that calculation done for you. And by the way, this is a calculator that's on my website. So if you want to go and do this calculation for yourself, you can go to my website, strittmatterwealth.com, and we have a pension calculator on there that can help you determine how much life insurance you need. But back to this example with Bob and Julia, they're both age 60. He wants to retire at age 65. His life expectancy is age 89 and hers is 90. The single pension at retirement, again, is $28.75. The joint is $2,010. They do not have a cost of living adjustment. So Lockheed does not have a cost of living adjustment. And then again, that difference between the two is $865. So the amount of death benefit that's required to replace that $2,010 per month once they turn age 65 is $322,171. So that's the amount of life insurance, again, that would kick off $2,000 for the rest of Julia's life. Now, something unique about this calculation is that once you choose the life insurance amount and you put that in place for yourself, what happens is that as you get closer to your life expectancy, the death benefit need goes down. And that's because it would need to pay out over less years. This illustrates that idea in this chart. It shows you their ages, the payment, the two different payments rather, and then the lump sum required to replace the pension, that 2010 benefit amount. Notice it starts at $322,000, and then it goes down each year, and eventually it ends up at their full retirement age. It'll end up at 0. So I want you to pay attention to one number here, and that is the age 85 amount of 121,833. That's 20 years in, because I'm going to come back to that number. The death benefit needed at age 85 is 121,833. Today it's 322, 121, 20 years after that date. Now then, let's talk about the strategy for life insurance and how to correctly set this up for yourself. So first of all, there's two types of life insurance. You have cash value life insurance, also called permanent life insurance, and then you have term life insurance. So permanent life insurance goes your entire life. Examples are whole life, universal life, variable universal life. These are all insurance policies that go for the rest of your life. And there's two components. There's insurance and a cash value or investment component to it. Compare that to term insurance. Term insurance is for a specific term of time, so 5, 10, 20, 30-year time. And at the end of that term is when that life insurance expires. So, and there's no cash value component to term insurance, and therefore it's typically less expensive because there's no investment portion to it. So that said, what's typically used for pension maximization, and by the way, that's what I've been describing to you, is pension maximization is how you get more out of your pension by using life insurance. What's typically used is permanent life insurance or cash value life insurance. And the reason for that is that we don't know when we're going to die. And if you want to make sure that you have a benefit left over for your beneficiary, then cash value life insurance gives you that protection of having 100% guarantee that will pay out to you for the rest of your life. And again, term by itself may not be a good solution because it may expire before you do. So one of the things we look at, though, is a life combo strategy. And what that means is you're using both cash value life insurance and term insurance with the idea of paying less in premium. So remember I said that cash value life insurance is more costly than term insurance? Well, we need to make sure that our numbers can work, right? And so one of these ways that we can reduce the cost of the life insurance is using a combo strategy. So let me show this to you. In this example, we're going to look at a 20-year term policy and a guaranteed universal life policy. That's a cash value life insurance policy. And so from the previous example, again, the life insurance was $322,000 that was needed. And again, the year 20 life insurance need was $121,000. So the difference between those two amounts is $200,000. So this strategy looks at purchasing that 20-year term life insurance for that amount of $200,000. And then using the cash value life insurance, the guaranteed universal life policy, and buying $121,000 worth of death benefit. And how this works, folks, is that after the 20-year term expires, what you're left with, again, is that need of $121,000. So that 20-year term can get you there a whole lot less expensive than if you just simply bought the guaranteed universal life on the entire amount. And so that reduces the amount of premium that you have to pay. What's neat about Lockheed, by the way, is that you already have a guaranteed universal life policy. And in fact, we've used this policy for many years now as the tool that we use for this strategy. And the reason is that it's very low cost. So it's a low cost policy while you're working there, and it's a low cost policy while you're not working there. The policy premiums change once you retire, because you're no longer in the group, but they indeed are less expensive than going out and buying your own policy on your own. So it's a great tool for this strategy. And so back to this example, the cost of a guaranteed universal life policy, if you simply purchase the entire death benefit need of $322,000, is $3,198 per month. Compare that to the term and perm combination. 20-year term for $200,000 is $1,144 per year. GUL, a guaranteed universal life cash value policy, is for $121,000 death benefit is $1,389 per year. So the total cost is $2,533 per year. So the savings over just doing the cash value life insurance policy and paying $3,198 is $665 per year. So the total increase in pension using pension maximization then is basically that $865 additional amount, which is that $10,380 per year, minus 2,533 or 7,847 per year, or 654 per month. So in this example, we were able to put an extra $654 in your pocket because we use this pension maximization. That's $654 per month. What could you do with an extra $654 per month in retirement? By the way, that's throughout your entire retirement. Folks, this is a very effective strategy. And again, something we use quite often. I highly recommend that you take a look at it. Let's switch gears now and look at your 401k savings plan and talk about some strategies that you can use to help you retire successfully. So first of all, Lockheed has a great matching plan. It provides a company match of 50% of the first 8% of your contribution. And in 2021, the 2020 and 2021 haven't actually changed. It's still $19,500 for salary deferral, and then $6,500 catch-up contribution if you're over the age of 50. So a total of $26,000 if you're over the age of 50. And at Lockheed, you can save either pre-tax, post-tax, or into a Roth 401k component. Folks, it's so interesting. We meet with a lot of people who do not contribute up to the match. So one of the first things I'm going to tell you and recommend to you is take advantage of that free money that's being paid to you by Lockheed. Take advantage of that match, in other words. And this just shows you how much more money you would have if you did it. But it's kind of a no-brainer, right? Is at least contribute 8% to your 401k at a minimum. That way you get that free money that's being paid to you. Lockheed is also unique in that you can actually save more to the 401k than the IRS annual maximum. So you can contribute beyond the annual salary deferral limit up to 40% of your base pay if you're eligible. The maximum contribution amount for profit sharing plan is the lesser of 100% of compensation, or $58,000, or $64,500, including the catch-up contribution in 2021. This means that you can put more money into your 401k than just the IRS limit of $26,000. Folks, if you're playing catch up and you're trying to save more money for retirement, this is an excellent way to do it. And it's simply just contributing more to your 401k plan than what typically most people are able to do. Most people don't know that they can do more than that $26,000. Now, what you do need to know is when you save past that $26,000, that's saving to the post-tax portion of your 401k. So it doesn't get to go in pre-tax. However, there's a benefit to that actually. And that is that when once you've retired and you rolled your 401k into an IRA, the post-tax portion can actually be rolled to a Roth IRA. Really neat benefit to you. It's just a few years old that the IRS changed this law. But when you retire, if you've saved to the post-tax portion, you'll get a separate check for that dollar amount. And in doing so, you want to make sure that you deposit that into the Roth IRA instead of your traditional IRA. And again, the benefit of that is that all of those earnings based off those post-tax contributions will not be taxable to you. They will grow tax-free inside of that Roth IRA for the rest of your life. At your death, they can be passed to your beneficiary and they would inherit those tax-free. So be sure and take advantage of that strategy and roll that into your Roth IRA once you're retired. Also on your 401k, 401ks are unique in that they're called direct transfer assets. Direct transfer assets means you can avoid probate by naming a beneficiary. And so on your 401k, when you go in to set it up, it asks you who your beneficiaries are. You can name both primary and contingent beneficiaries. Primary beneficiaries are who will inherit that money upon your death. Contingent are who would inherit if your primary beneficiary predeceased you. So it's always good to have both primary and contingent beneficiaries because you never know if you're going to be in the same car as your primary beneficiary. And then if there's nobody on file, it would go to the estate and then thus be subject to probate. So again, a direct transfer means you avoid probate. All the beneficiary has to do is provide a death certificate to the 401k plan. And in doing so, that would pass directly to them. There would not be a need for an attorney to get involved. There would not be a need for you to go probate that money. And if any of you have done probate, that can be quite costly and time consuming. So great benefit. You just got to make sure that you've named a beneficiary. Also, through your company plan, you may have purchased Lockheed Martin stock. And there is a special rule that's called net unrealized appreciation that allows you to reduce the taxes that you pay when you roll that stock to a non-qualified account out of your 401k once you've retired. And so in doing so, you're simply taking the stock portion of it and transferring it to that non-qualified account. It's simply not an IRA. That's the best way to think of a non-qualified account. It's not an IRA. And in doing so, you're going to pay tax at a lower rate, assuming that you kept track of your cost basis. And the great thing about Lockheed is they keep track of your cost basis for you. So you would request your cost basis from Lockheed. They would send that to you. Cost basis is the price that you paid for that stock. And then in doing so, you would pay tax at a lower rate by using this strategy. Now, before you do that, you want to talk to a tax advisor to make sure that that strategy is going to work for you, because you will have to pay tax on the money when you pull it out. It just would be at a lower rate. So you need to do some calculations. That's something obviously that we can help you with, and we can help you to determine whether or not that would be right for you. The alternative, just so you know, is that you would liquidate that stock within your 401k and then transfer it over into your IRA. And in doing so, it would just come over as taxable income when you pulled it out. It would all have the same basis, which is the entire amount is taxable. Now, Lockheed is also unique in that they can provide medical benefits for retirees. And if you're eligible for this, you can call the Lockheed Employee Service Center at that number there. What's unique about this is they may subsidize the premium for you. So what we typically recommend folks to do is to call that number in advance of retirement and to get information about that insurance for yourself, get quotes, and then compare those to outside coverage. Here lately, because the cost of outside coverage is so expensive, a lot of times Lockheed insurance is actually just as comparable. Now, if you're getting a subsidy, that's even better. So that's something particularly to look into, is to find out if you qualify for the subsidy. But as everybody knows, the cost of health insurance has just skyrocketed in recent years. So that's something to plan for in advance before you retire. And that's, again, something we can help you with as well. Also, something unique to Lockheed is the Medicare supplement Advantage plan through the One Exchange. So once you reach the age of 65, you're eligible for Medicare health insurance. That's the federal health insurance plan. And Lockheed provides a subsidy to a health reimbursement arrangement to offset some of the costs for eligible employees. You have to enroll for Medicare Part A and Part B, and you have to enroll at age 65 or you will lose the company subsidy. So that's something to plan for in advance and make sure that you are able to get that subsidy. And a lot of times when we've reviewed outside coverage of Medicare plans, Medicare supplement plans, that's usually a pretty good benefit for you. So oftentimes we'll use the Lockheed Medicare supplemental plan through that One Exchange. And then health savings accounts. Health savings accounts are a great idea, folks, as it says there. So these are savings plans that you're eligible for if you utilize the high deductible health insurance plan. And so Lockheed has a high deductible health insurance plan that is HSA eligible. So if you're utilizing that, that allows you to save pre-tax dollars into an account that can be used to pay for medical expenses and subscription medications. The maximum contribution for that in 2021 is $3,600 if you're single, or $7,200 if you are providing family coverage. And then if you're over the age of 55, it's an extra $1,000 per year catch-up contribution. So $4,600 if you're single, or $8,200. And when used for medical purposes, there's no tax on the distribution. It's one of the only accounts that allow you to not pay tax on your income. So it's very unique. Also, what's unique about your plan is that you can contribute through Lockheed. So they allow you to do that through payroll deduct. And what's unique about that, folks, is that not only do you not pay income tax on that contribution amount, you also don't pay FICA taxes on that contribution amount. FICA taxes are Social Security, Medicare, and that's 7.65% of your pay. So for years, I used my own health savings account before I did it through my company, and I would not get that benefit because I saved separately. Now I do it through my company, and I save that additional 7.65%. These are your funds. You can take them with you once you're retired. These can be invested. So you can take these dollars and invest them if you continue to build them up. You can't make contributions once you enroll in Medicare, so be conscious of that. And then once you turn age 65, if you use for non-medical related expenses, you are no longer penalized the 10%, but you are taxed at ordinary income taxes for the distribution amount. So before age 65, if you use it for something other than non-medical, you pay taxes and a 10% penalty. Post age 65, you no longer pay the penalty. So by the way, our advice is always to maximize or contribute the maximum to your health savings account every year, folks. There is no account that provides that much benefit to you for tax purposes. So always try to maximize that account. And then portable insurance. Once you retire from Lockheed, there are several insurances that you can take with you. Portable means that you can take it with you. And so here's a list of those: employee term life, group universal life. That's the cash value life insurance policy that I was describing to you earlier. Special accident, dependent optional term life for your dependents, supplemental medical, long-term disability, long-term care only if you participated in the John Hancock plan years ago. That's no longer available to you. If you try to increase those coverage before or after you retire, proof of insurability would be required. So you can take what you already have, but if you want more, they're going to ask you to go through underwriting. Okay, in the top 10 retirement mistakes to avoid when retiring from Lockheed, folks. So the first is not taking advantage of your full 401k match, 50% of 8%. Again, a no-brainer, folks. Get that free money. Not taking vacation and then retiring. This is a strategy to maximize your health insurance benefits. So if you have quite a bit of vacation saved up and you want to try to extend your health insurance coverage, you can take that vacation pay for as long as you can rather than having it paid out to you, and then defer having to pay medical premiums or higher medical premiums by doing so. Number 3, not using your pension maximization strategy. That's what we talked about earlier, using that life insurance to help get more out of your pension. Number 4, not utilizing Lockheed Martin Guaranteed Universal Life. Again, a very low cost life insurance policy. Not using post-tax portion of your 401k to save more money. Again, saving additionally beyond that $26,000 IRS limit. Not rolling post-tax portion of 401k over into the Roth IRA. Again, that allows it to grow tax-free for the rest of your life. Not naming a beneficiary on your 401k, avoiding probate. Not taking advantage of net unrealized appreciation for Lockheed Martin stock if you save that into your 401k. Not utilizing Lockheed Martin healthcare and Medicare benefits. And then number 10, not contributing the maximum to your health savings account each year. And we actually have a bonus, not using Strittmatter Wealth Management Group to plan for your retirement. That is just a ruthless plug, folks. So what are the next steps? Well, what I would do is I would begin to gather information. So I would begin to write down your objectives and questions based on what you've learned in this class today, and then take action. So retirement planning is not done a month before you retire, folks. It's done over years. And so if you'd like help with that, I would encourage you to request a complimentary consultation to begin your retirement planning process. And we can also look at pension maximization for you. You've seen at the bottom of your screen, you can email us at info@strittmatterwealth.com or just give us a call at 817-210-3444. What we offer is comprehensive financial planning. So we do retirement planning, tax planning, estate planning. And we are certified financial planners, and we charge a flat fee for financial planning services. For investment management, we are an independent registered investment advisor. So we have no proprietary products, no affiliations, so no conflict of interest. We use institutional style investing, and we charge a flat percentage charged based upon the asset levels that you have. And then insurance, I own an independent insurance agency as well. And we offer typically long-term care insurance is the one we look at for most retirees, simply because that is a big risk to retirees these days. So you can request a consultation to learn more, and I'll be happy to sit down with you and tell you more about it. Thank you very much. If you've enjoyed today's presentation, please subscribe to our Lockheed Martin blog. You can do so by clicking on that link there, and or just go to my website, strittmatterwealth.com, and you'll find that blog. We also have some fantastic newsletters that you can sign up for. We have a weekly market update, a monthly retirement ideas update, monthly lifestyle and events newsletter. And then we also teach classes, although right now we are not teaching many classes because of COVID, but we will be kicking that back in hopefully by the second half of this year. And the classes that I've taught over the years are strategies for successful retirement, Social Security optimization, wills, trust, and estate planning. Those are taught at several colleges, including UTA and TCC. Visit our website, strittmatterwealth.com, for future financial education events. And then please like us on Facebook to receive information on future events as well. Folks, again, thank you very much. I hope you've learned quite a bit today. I'm going to stick around. If you have any questions, I'll stick around to answer those. Otherwise, we are done. I hope you have a great weekend and enjoy the hopefully sunny weather that's coming our way. Thank you very much.